right, welcome back, everybody, to Dirty Boots Capital. Today we have Darin Tuttle with us, and we're going to be talking about investments and a whole bunch of different ideas that you folks can put to use and take action on. So, Darin, welcome to the show.
Hey, thanks, Tony. It's great to be here.
Excellent. So, Darin, you are the Chief Investment Officer for Tuttle Ventures. That is your own company that you founded. How long ago did you found the company?
That was back in May of 2021, so a couple years.
Excellent. But you've been in the business for a long time. You've worked for big name firms. You know your stuff. Darin and I jumped on. We've been chatting here for the past 30 minutes before hitting the record button, and Darin has a wealth of information that we're going to get into. And so the first thing I want to jump into are bonds. What the heck is going on with the bond market? If you can help us understand that, that already is going to be a huge accomplishment, because I was just looking at the 210 spread again this morning, and we are in deep negative territory. Darin, what's going on?
Yeah, so let's break that down for a second, right? So what are bonds doing? Bonds are a promise of future payments that you collect over time. And this 2 to 10 inverted yield curve spread that you're looking at is that difference or dichotomy in time. Usually, if you lock up your money for 10 or 30 years, you're going to be collecting more money because it's a longer period of time. But right now, that's not the case. If you are willing to lend money, say on a 2-year time frame, you're actually earning a higher yield or a higher return than if you're lending money out 5, 10, 20, or 30 years. And that's why it's so backwards, is because the market is telling us, the bond market, or at least this is the way that I interpret it, is that they want money now, and they're willing to pay for it at a very high interest rate, higher than the money 10, 20, 30 years down the road.
Is that because of uncertainty in the market, which way we're going? And we'll talk about recessions and all sorts of things, but is that mainly because uncertainty in the market, uncertainty from a global political perspective? Is that what it is? Or are they just looking for liquidity just for liquidity's sake?
Well, I mean, the first is just like that base level of who sets interest rates, who's setting the price of money over time. And that's the Federal Reserve, right? So the Federal Reserve has jacked up interest rates over the last 18 months to, the 5%, 5.25% level. So the Federal Reserve is telling the rest of the market, hey, the price of money is going up. And this is going to be the new future going forward if you're going to be borrowing, going forward. So that's kind of a roundabout way of saying, like, yes, there's inflation concerns and you would want a higher return on your money for that. Yes, there's geopolitical concerns, with Russia-Ukraine war and some of the dynamics there. But at the end of the day, why did interest rates start rising in the first place? It's because the Federal Reserve wants to bring down that economic spending and keep inflation under control so that they have stable prices. And that's why interest rates rose, is because of the Fed's action first and foremost.
So sticking with that line with the Fed action, they just recently paused on hiking rates. It was the first pause in I don't know how many announcements. But do
Since
you think
1994, last time they paused was back in 1994.
It's been a long time. Yeah, long time. So do you think they will continue the pause, or do you think they're gonna continue to hike one or two more times this year?
Well, let me answer that in another way, right? So we can kind of look at 3 major events that have happened this past year that have supported the bullish case for growth here in the U.S. The first one is, I always was of the belief that the Fed was going to hike interest rates until they broke something. Well, in March of this year, they did break something. They broke the regional banks. And what did they end up doing? They ended up bailing out the regional banks. How did they bail out the regional banks? They created what's called the Bank Term Funding Program. And the Bank Term Funding Program is, because of this inverted yield curve, this 2-year cycle, they are fronting the money to these regional banks and saying, hey, if you have long dated bonds that are at discount to par, we're going to pay $1, even though right now they're worth 90 cents. And so because of that, that kind of has filled the 2-year gap that usually puts a lot of funding pressure because of the inverted yield curve. So that's number one, is that bank term funding program. That's been big. It's kind of been that stealth QE, quantitative easing.
Yeah.
The second is we had the debt ceiling, right? So there was a lot of concern about the debt ceiling, about what Congress was going to do, whether they were going to get funding for all these government programs. Government is a big part of GDP. If the U.S. defaulted on their debt, that would cause instability in the market, right?
Yeah.
But what happened with the debt ceiling? They didn't just raise the debt ceiling and like set another level. They actually suspended it, right? So there's not a debt ceiling at the moment. It is basically a blank check for the government. And they pushed out that debt ceiling till when? Till after the election in 2025. We don't have to have a serious fiscal conversation from the US Congress until 2025 after the election. And so that is giving a blank check for increased spending. The third is the pause, right? That's the biggest one for me going forward. And I think the most controversial, where I'll disagree with some of my peers, is with this Fed pause, because we've gone through this hiking cycle. Now that we're paused, this is where people are saying, they're calling up their mortgage broker and saying, hey, is now the time to refinance, or should I wait, a year from now when interest rates are going to go down? Well, that's where these big decisions are being made right now. Is the Federal Reserve done hiking, or will they continue to hike interest rates more going forward? We think that's like too binary of a view, and I can talk more about that in a second.
Yeah, it's so, as I say, it's so manipulated these days. The economy, these markets. A question that I typically ask folks, without leading the witness and share my thoughts, but do you think we have a free market economy anymore?
Well, what do you mean by
not to put you on the spot?
This is from the man who has written the book Freedom at Risk.
Yeah, so I guess it's a little you already know my stance on it. So yeah. Every time we have a malfunction in the market, the Fed backstops it. There's another 4-letter acronym that comes out from the Fed, a new window that they create to be able to backstop. And like you said, they're buying assets for 90 cents on the dollar, right? Or they're paying $1 for an asset that's worth 90 cents, right? So they're backstopping the collapse in many cases. When the collapse in the past, where these 4-letter acronyms didn't exist, those levers weren't in place, these markets would have imploded, right? Bad money would have gone away, new money would come in, and we'd rebuild from there, right? Things like, I'll go back, to 20 years, I don't think the term zombie company was in place. There was never a term to characterize these companies that weren't profitable or on the verge of failure. So these zombie companies make up, I've looked at a couple of different sources, somewhere about 20% of the companies out there in that range. 20% of the companies out there are zombie companies that aren't profitable, barely able to pay the bills. They haven't been allowed to fail after all these years. Get that bad money out of the marketplace, replace it with good money, grow something new that's worthwhile investing in. It just seems like it's backstop after backstop after backstop. And am I wrong to think, maybe we don't have that free market economy the way we used to?
No, I think you're spot on, right? I think you're highlighting a lot of, these really key points in the economy. The zombie one, just right off the bat, think about these zombie companies. Even though they're not profitable, what are they doing that the government sees as beneficial for them to exist? Number one, they continue to buy government debt, right? So they're buying up US treasuries. So they like that. The second is that they're keeping people employed. And so if you're keeping these people employed, even if their real wages aren't growing relative to inflation, they're placating the population. They're keeping these people in these jobs. And although they're not returning, a profit for their shareholders, they're placating the population, keeping the government happy. Here's the thing, Tony, we've seen this happen before in Japan in the late 1980s, right? Japan was on fire. They're like number one or two or three in the economy for everything. The stock market was booming, right? And then they went through a crash, a real estate crash, and they went through a lost decade. During that lost decade, they took on tremendous amounts of debt. They had a higher proportion of these zombie companies than the one that you even mentioned. And interest rates have stayed at or near zero since around 2015. And they just keep piling on the debt, pushing it out further and further and further. That's kind of the playbook here. If we don't take those hard decisions, make hard fiscal decisions, we'll become similar to Japan. Yeah. But the good news is that it's not all doom and gloom.
Yeah, thank you. Thank you for bringing us back to, to that, because I don't want folks to be, right. I don't want the viewers and the listeners to be paralyzed with doom and gloom. That is not our intent, neither mine nor Darin's intent. We want you to be able to take action, to be able to see through this economic fog that we're in. Okay. We have to be able to understand where we are today, what's happening today, why things are happening today, and be able to use some of these manipulations that are happening in the market, use them to our advantage to give us the understanding, the knowledge, the education to invest in certain assets and to press forward. It's so funny. Earlier today, I did a video and I highlighted a whole bunch of spread charts from the Federal Reserve. Basically, every single one is talking about, you look at it and it just reeks of recession is on our doorstep, right? However, despite that, I also just recently published an article like you, Darin. You write a lot. You have your Substack newsletter, which I encourage folks to go, seek out that newsletter on his website, on Darin's website, and go subscribe to his newsletter. He just published his 100th newsletter. So that is amazing. Congratulations on that, Darin. That's awesome. Putting out that content, that valuable content for our viewers, for our listeners. That's good stuff. And so I also published on my blog why recessions don't matter anymore. Because of this manipulation going on in the marketplace, even though the indicators appear to be saying we have a recession coming, let's not be fooled. Let's not be lulled into the fact that there is manipulation going on, and there are still great investment opportunities out there. So yeah, I don't want people to get paralyzed. There's still a lot of great stuff out there. And so with that, I want to transition to, you look at this stuff all day long, Darin. You know the market very well, incredibly well. Which sectors do you like the most? Is it the financial sectors, banking stocks? Do you like, the healthcare, or is it, tech? Tech has been on a streak recently, right? Do you like tech stocks? What is it?
Yeah, for me, I'm going to take that question. I'm going to flip it a little bit. And instead of the sectors, I'm going to talk about the countries.
Oh,
right?
Okay.
So if we look outside of the US, right, our interest rates are around 5%, right? Where are countries willing to grow and pay an interest rate of a higher return than 5%? Let's look at India. You have Chile, you have Mexico, you have Brazil. These are all countries, emerging market countries that are growing, that have pretty solid demographics, right? A population base that we are optimistic for going over the next 3-5 years. Their valuations are not at the elevated levels that we're seeing with technology stocks here in the US. And so when we're looking at opportunities, these countries, we think, have a positive risk profile going forward based off of their growth, the ability to pay out higher interest rates, and then bring that back to the US.
Yeah, definitely. It's so funny when you started going down that road of, looking at things more globally at emerging markets, my mind immediately went to India. You have China building their Belt and Road Initiative right through India into Europe. And India is so ripe for growth right now, not just because of that. That would be like, that and that alone, with China building in the Belt and Road Initiative, that alone will help India. But India also, from a population pyramid profile, they are what you want to see. They have a very big base of young people that are just starting to come up through the grow up through the ages, starting to buy houses, starting to buy goods and services, right? So they have a very strong base of young people actually consuming, right, being the consumers to drive that economy and be able to be the base for manufacturing and technology coming ahead. So their population profile is incredible, as opposed to say China's, which is their profile is upside down. Like Japan's also in a world of hurt when you look at the population profile. So yeah, those are two things, two very good reasons I like India. So when you talk about India, so how do you invest in India? How are you doing that?
Yeah, so that's a really good question. I think one of the things is, what does it take for me to move a US dollar, right, King dollar, and put it into India? The first thing I need stability. I need to know that that country or that government is willing to work with the US, that they're going to abide by like US bankruptcy laws, right? And that they're going to have a backstop and honor their word. So that's number one. You need political stability, which I think we do have right now.
Yeah.
The second is, I need to be able to have interest rates be stable here in the US, right? I don't want to have to be checking the US dollar, India rupee,
Yeah.
exchange rate every single day, right? I need to have those exchange rates be relatively stable and have them be on a lower interest rate differential, right? I need those to be somewhat stable to take that dollar and to put it overseas. And then the third thing is, I need a higher return than what I could get here in the US. And so in different sectors here in the US, technology, I think, is receiving those dollars because we have great technology companies here. And those technology companies are building deflationary things, right? Technology is inherently deflationary.
Yeah.
But at some point in time, I just can't put myself to put another dollar into NVIDIA when it's priced 200 times earnings, right?
Yep.
200 times. So maybe there's companies over in India in which we've done the work. We actually know that there is, to be able to put that incremental dollar to work in their economy that are at much more reasonable valuations that we think have greater potential upside in the next 3 to 5 years. So how do we do that? Right now, we're doing it through a passive product. So this is an exchange traded fund. MSCI has those. I think the ticker on this one is INDA, but it's not an individual recommendation just for that one. I think there's like 7 or 8 of these passive exchange traded funds that are giving you diversified exposure to a broad snapshot of the economy in India.
That's a great response, because the price to earnings ratios out there for these US stocks are just they're very lofty right now. And I feel like there's only one place for them to go should the tide turn. And as Warren Buffett says, you start to see who's swimming naked out there, right? So on the opposite end of the spectrum, what do you see out there for investments that are toxic, that you are absolutely staying away from, right? Maybe some of our viewers, some of our listeners might be in some of these, and I don't know, maybe they are, maybe they aren't, but I want to be able to give that full spectrum of goodness versus badness.
Oh yeah. There's a whole lot of bad out there that you could kind of pick and choose. It's difficult because, if I saw, what somebody was already invested in, then that really is like, okay, then that, I have more questions here. I want to know more about this. I think on the private side, right, relative to the public side. So public side, those are like those exchange traded funds, those ETFs or stocks, those get priced every day, right?
Yeah.
On the private side, maybe that investment that you had in that venture deal, or maybe that private REIT is not actually getting priced every day. And so we've seen prices in the public markets come down over the last 3 years. Have those prices in the private market also come down? Some have, some haven't, right? And so I think, are still at a period now where if you're looking at something that's toxic, you may not be able to even see it right now because you're not getting the most recent up-to-date prices. And so I still think there's some things there that we can kind of work through, look through, and be able to find, so for me, stay away from things that you can't get a price or an accurate price that you feel confident about behind that.
Yeah, and it's just reminiscent of those I think it was a total of 5 bank failures that you had mentioned that we had earlier this year. When I did a deep dive into that, I mean, it kind of came back to kind of the scenario that you're talking about. You don't know real time where something is, where that your investment dollars actually are. Because if you look at some of these bank stocks, or it could be any institution, how they're evaluating their assets, right? I use the analogy of, I personally, I almost think everybody should be using mark to market, right? Value that asset today in today's dollars, so I know where it is today, right? And for the viewers out there, for the listeners, again, not every company does that. They actually could take a look at the value of something in their portfolio in terms of what is the value of that, 5 years from now or 30 years from now, or what they actually paid for it, right? A lot of companies, if they're holding an IPO stock that came out 2 years ago and, went to the moon, right? Lambos for everybody, right? We remember those days, right? 2 years ago, if they bought that IPO stock and they bought it at, $20, there's a lot of those $20 stocks in people's portfolios that are now 50 cents, $1, right? And so when you're looking at these investments, what are they actually evaluating and wrapping dollars around that particular asset? Is it what their purchase price? Is it the value of it 30 years from now? Is it mark to market, what it's valued at today? It's so hard to kind of wrap your head around that. So yeah, you're right. It's complex. This is hard stuff, and this is why we go to folks like yourself, Darin, to help us not be paralyzed, right? Because as I share with folks, and I've done videos on it, if you're paralyzed and you're not taking action, it's probably because you're not the right person to be taking action on that. You need to do something, and that's great. That's a great first step. And if you're paralyzed for any amount of time, go seek out somebody who is trained and capable to be able to further that action and help you make decisions. I'm not a stock picker. I know enough about geopolitical environments. I know enough about stuff, but I'm not an expert, right? I'm not, somebody like a Darin to be able to help you navigate through this sort of stuff. So, I wanted to showcase Darin here because he is such a wealth of information for the viewers, for the listeners, to be able to go, if you're paralyzed, look up Darin, give him a call. He's a nice guy, right? He's friendly. He's a good looking guy. Call him, right? He's not an intimidating guy. So please reach out to him. And with that, so I want to make sure, again, I mentioned your newsletter that's on Substack. People need to go find. How do they find that? Do they find that through your website?
It's right there on the website, tuttleventures.com. Or then if you're on Substack, it's Actionable Market Insights. I'm also on Twitter. I think I'm 5,000 followers or something like that. So it's at Darin, DARIN_T80.
Yeah, I'll share with the viewers. I follow you. I look at your posts and it's just my head explodes and I'm like, oh my God, this guy is definitely on the front end of the curve here where we need.
But let me tell you this, Tony. We do try to complicate things, and I think complicating things creates job security, right? So if I start using a whole different technical language with you, then we could keep ourselves employed for a really long time. At the end of the day, when you're making investments, time is your most valuable asset, right? And then the next is all about the cash flows. So how much is it cash flowing today? How much is it going to cash flow into the future? If you can knock down those two things, understand your timing, understand your cash flows, you're going to be in a really good place.
Yeah. Good. Those are great, great words of advice. Darin, thank you for joining us here today. I appreciate you. So grateful for your time today. And maybe we can get you on in another 6 months, see where the market is, and do it all over again.
Yeah, would love that. That would be great, Tony.
Excellent. Thank you, Darin.